Markets today are being rattled by worries over currency depreciations, deflation, slowing growth in emerging markets, and slowing earnings growth in the United States. It's all an echo of markets in a similar era, late 1997, a period that came to be known as the Asian financial crisis. Asian countries kept rates high through the early 1990s in order to attract foreign investors, and it worked for a while. Growth rates soared, and soon the pundits were referring to the Asian economic miracle. But when the U.S. began raising rates in the mid-1990s, money began flowing back into the United States. That became a problem. The U.S. dollar strengthened, and because many had currencies pegged to the U.S. dollar, the higher dollar drove up the price of exports, and those countries that were big exporters suffered. Lenders withdrew credit, and it caused a huge credit crisis. The resulting slowdown, called the Asian flu by some, sharply reduced the price of oil. It went to about $11 a barrel in 1998. That resulted in many mergers in the oil business, including the biggest of all, the merger of Exxon and Mobil in 1998. That collapse in oil revenues by many oil exporting countries led to the Russian financial crisis in 1998, when Russia defaulted on its debt. The crisis put enormous pressure on the U.S. stock market, and on October 27, 1997, it even caused the U.S. stock market circuit breakers to kick in and shut the market before the normal close. That was the only time that's ever happened. Fast forward to today, and the themes are the same: a China economic miracle, a strong currency, currency devaluations, and deflation. Low oil is also a common theme, though this time the decline is due to supply increases, not demand reduction. The bottom line, while China is a much bigger player this time, there's nothing new about panics and the resulting capital flight. Back to you, Melissa.
All right, thank you, Bob Pisani from the New York Stock Exchange. Tim, I think you were in Russia at the time.
I was living in Eurasia at the time.
Yeah.
And let me tell you what's very different. He mentioned the pegs on the currencies. What's very different, we've already had a major adjustment in global currencies everywhere, except for Saudi Riyal, which people are worried about, and what's going on with the yuan right now, which is starting. The painful part of this is it's starting to revalue. So debt to equity on the sovereign level around the world, very different place. Private sector debt, a big problem. But if you look at China, they are probably 3/4 of the excess debt in EM, and they have more reserves to pay for. I'm not saying it's good, but again, to say this is 97, 98, to me is off the mark. I'm not going to say irresponsible. I'm going to say off the mark. I think the market can go lower, but again, to say that you want to run for the hills here, China policy is clumsy. We don't want to bank on it, but it's not going to necessarily take our economy down. Right. And it's very clear to me.
You were actively trading at that time, I would imagine.
Back in the day.
Back in the day. Is it similar?
The currency move, I got to tell you something. The currency moves we take them as normal now. The currency moves we saw in 97 were nothing close to what we're seeing now on a daily basis. Yeah, you had your one-off once in a while, but you see currency moves of ridiculous magnitude on a daily basis, and we discount it like it's normal. It's not normal to see currencies move 2% and 3% in a day. There's something inherently wrong with that. There have been books written about currency wars, and I believe we're right in the midst of it. Now, whether or not it all ends well, I have no idea either, but it's clearly not healthy for global markets, in my opinion.
97 or 98 or 2008?
I think I would say we're closer to a 2008. There are parallels to 97. The one thing that I would say that's a big difference about both 2008 and 97 is that the Fed had room to cut rates, and they did cut rates. No place to go this time.